A $39 billion mega deal to take over Alexion Pharmaceuticals, the company's biggest deal since it was founded. Matt?
Let's take a look at European futures here. We've had kind of a mixed picture today with German futures gaining, FTSE futures unchanged. That could be because of the strength in the pound on the Brexit optimism. That's why you see FTSE futures not moving much. But interesting to see DAX futures, as we were just talking about with Danny, even as Germany faces a new, harsher, hard lockdown on Wednesday. Here's your global macro mover screen. The left-hand column shows you the equity indexes. They populate there live as they start trading. The FTSE straight out of the gate down 0.2%. But as I said, that's probably due to, for the most part, the strength in the pound as these Brexit negotiations pass. Can you believe it? Another deadline. The IBEX in Spain up more than 1%. So what will be one of the bigger gainers on the continent, the Spanish IBEX really soaring out of the gate this morning. The CAC 40 in Paris up about 0.75%. So the CAC itself not doing poorly. And as we've been saying this morning, you should expect the DAX to open higher as well. That's even as Germany is set to enter a harsher lockdown from Wednesday. Non-essential stores will be closed before, remember, what is the all-important pre-Christmas shopping day or pre-Christmas shopping week. Employers are urged to close offices. School children encouraged to remain at home. These tighter measures are going to last well beyond Christmas, well beyond New Year's as well, until January 10th at least, and include a ban on gatherings over the new year as well. Chancellor Merkel was pretty serious about that. Nobody will be partying on New Year's Eve this year, or at least not legally. Joining us for more is our Germany reporter, Arnie Delfs. Arnie, how do these new measures compare to earlier lockdowns? This is one of the harshest lockdowns, I guess, that we've seen in this country.
Yeah, hi, Matt. Yeah, indeed. I mean, during the first wave, we had similar measures. The difference was that they came earlier and therefore were also fit to break the wave before it became bigger. This time, we are actually past the wave already. So it's kind of a last-minute effort. But clearly, especially the Christmas and New Year's measures, are pretty tough for Germans who are, as you also know, especially on New Year's, are used to do fireworks. That won't happen this year in Germany.
I have to say, I spent a lot of money buying fireworks this year, so I'm a little bit personally bummed out. Over Christmas, I was hoping to go down to Berchtesgaden. I'm guessing hotels there are going to be shut. I haven't called to check that yet, but what does this mean for most Germans over Christmas?
Yeah, well, that you have to bring your tent probably to if you want to go down there. For most Germans, it will mean basically they'll have to stay home more or less. No? I mean, there are in certain states there's a certain loosening of measures. So there's 4 people plus 5 of another household. So it will be a very quiet Christmas, and probably also with less presents this year. You know, maybe you order on Amazon last minute here, but and many Germans, this is one thing I don't really understand. Why it only starts on Wednesday? Because of course today and tomorrow the shopping will be crazy and the shops will be filled. You know, many people will infect themselves.
For sure,
it's a bit strange.
Yeah, absolutely. I mean, I'm going to rush to do all of the shopping I need to, at least anything brick and mortar in the next couple of days, and I guess I'll just wear 2 masks because
exactly.
I know those. I know those stores are going to be packed. Arnie, thanks very much. German government reporter Arnie Dell's going to continue to cover this for us, and of course he's going to be covering very closely over the next year what this means for the CDU. And Anna, this is going to be, you know, especially if it results in a big hit to GDP and bankruptcies next year, it's going to be tough for Angela Merkel. Well, not her; she won't be running again, for the CDU, for the ruling party, because it won't look good.
Yeah, we're going to have further analysis, aren't we, of the political implications and, importantly, the economic implications of this in around half an hour's time, when we'll get some analysis on the German economy in light of these lockdown measures. Let me just mention some other lines coming out this morning from Michel Barnier. According to an EU diplomat, Michel Barnier says that a narrow path to agreement is something that he sees. And we are seeing the pound pick up a little bit on the back of that. So now the pound up 1.3% at back over the 134 level. I seem to remember we were talking about 134 at the start of last week. So let's talk about all of these European themes. We've got the lockdown in Germany. We've got the Brexit negotiations not resolved, as maybe we'd anticipated over the weekend, but facing further talks. So European markets, with all of that opening higher, lifted perhaps by talk of stimulus stateside as well. Banks and travel and leisure lead the Stock 600 index. The pound is, as we said, going higher. Joining us now is Bob Parker, Quilvest Wealth Management Investment Committee member. Bob, when you look at how European markets are responding, on the downside, we've got further lockdown measures in Germany, and we've got talk of further measures in other parts of Europe. But to the upside, there does seem to be some substantial Brexit relief already, despite a lack of finality on those talks and some talk around US stimulus. Are you surprised to see just how optimistic a view markets are taking of all these factors this morning?
I think you've basically got 3 factors in play here. The first is, let's not forget, which you discussed at length last week, is the support from the passage of the EU budget and the support for the EU recovery plan. And at one stage last week, that recovery plan and the budget looked in jeopardy because of opposition from Poland and Hungary. But that 1.85 trillion, if you include the budget and the recovery plan, is a very strong fiscal support for the Eurozone economy going into 2021. I think also last week, obviously, the expansion of the pandemic emergency purchase program by the ECB, and also some easing in their lending to the banking system through their TLTRO program. So I think so the first point to answer your question is that action by the EU on the fiscal side and by the ECB on the monetary side is market supportive. I think the second area is what's happening in the States. It looks as though there will be some progress this week towards a fiscal package. It looks as though that's going to be just over $900 billion US. There are still some areas of debate, and so particularly the question of guarantees and support for companies which may be exposed to lawsuits due to the coronavirus. But I think there is an air of optimism that that fiscal package in the States will go through prior to year end, and that obviously is very important. I think also in the States, let's not forget, we have the Fed meeting this week with a high probability that they will actually expand their QE program.
We can talk about the States, and we will, Bob, because the S&P 500 keeps hitting new highs. It's up 14% basically year to date. So something investors like something there, and it's kind of the mirror image of what we're seeing happening in Europe. The FTSE is down 13% year to date. And in fact, almost all of the major European equity indexes are down year to date. Even the DAX, Why is Europe lagging so far behind? Have the shutdowns been harsher? Has the bridge been weaker? Are we going to see more bankruptcies here? What's the reason?
I think a number of factors. The first factor is, let's not forget that the Eurozone economy this year has been hit, and when I say the Eurozone economy plus the UK has been hit much harder than the US due to the coronavirus. And the growth differential this year, I think, is very clear. Now, that'll probably reverse in 2021 with European growth actually outperforming that in the US. I think the other factor, of course, is look at the components of the S&P versus the components of the Euro stocks. And up until recently, the S&P has been led by the tech sector, and that's clearly demonstrated by the outperformance of the Nasdaq. So, whereas the US is tech heavy, the Euro stocks is industrial heavy, consumer heavy, and tech light. So that composition also explains the outperformance of the S&P. I think also you can argue that one goes back to the second quarter of this year. The Fed action was probably more aggressive in easing monetary policy than the ECB. I would actually say now the Fed and the ECB are probably moving together. I think it's interesting that in recent weeks we've started to see the Euro stocks actually start to outperform the S&P. So we are seeing finally that rotation back into Europe by investors.
Bob, thanks very much. Bob Barker, Quilvest Wealth Management Investment Committee member, of course, stays with us on the programme. Up next, we'll get to that conversation about the US. A bipartisan group of US lawmakers plans to unveil a $908 billion pandemic relief proposal, but one of the negotiators says there's no guarantee Congress will pass it. US futures edge up this morning. Plus, Amazon unveils a full functioning self-driving taxi. We will hear from our exclusive interview with the CTO on that project, the Chief Technology Officer. This is Bloomberg. Welcome back to the European Market Open. 13 minutes into Monday's trading session, and quite a lot of movement on these markets to talk you through. European equity markets up by 0.8%. The FTSE 100 is a laggard because we've got that pound strength to contend with, and also the move on AstraZeneca will be weighing on the FTSE. So AstraZeneca making that big approach, $39 billion deal for Alexion. That is weighing on the share price. It's down by 5.4%. Elsewhere, though, in London, we do see some optimism around the Brexit talks. Michel Barnier saying this morning that he can see way to a deal, and so as a result of that, Lloyds is moving higher. Some of the other more domestically focused banks and other businesses also moving higher. Delivery Hero moving to the upside. That on the back of Germany going into a much tougher lockdown for just under a month, it would seem, at least, and that is going to be introduced from Wednesday. Matt?
All right, U.S. lawmakers are pushing a $908 billion coronavirus pandemic relief plan. This is the latest bid to break months of deadlock, but doubts remain over whether Congress will pass it. West Virginia Senator Joe Manchin guaranteed that hard-fought negotiations will produce results, but of course there's a competing package, $916 billion package from Steve Mnuchin. Bob Parker, Quilvest Management, Wealth Management Investment Committee member, is still with us. Bob, do we assume some kind of basically trillion-dollar package goes through now, and then President Biden starts working on more relief after January?
Well, this week's pretty critical. They've extended the debt ceiling deadline to the 18th of December. So, that needs to be extended further, unless if that doesn't happen, we're going to get a government lockdown. That's one thing to watch. I think the central case is, as you described, which is that this week, or at worst next week, we get a 900 billion plus package. That is very important indeed, because if no package goes through, then approximately 12 million workers in the US will actually lose their benefits at the end of the year. And that obviously has negative implications for consumer demand and overall activity for the US economy going into January. And that's against the background, of course, that after very strong October numbers in the US, recent data on consumption, activity numbers, a number of the surveys like the Philly Fed survey, the New York Fed manufacturing survey, have started to show data for November and December as certainly weakening. And I think that was confirmed in the jobless claims numbers. So there is a lot of pressure to get something done. So I don't think you're going to get the $2 trillion package that the Democrats want, but a two-stage process, $900 billion this week, followed by possibly another $1 trillion of fiscal relaxation once President-elect Biden finishes the inauguration process on the 20th of January.
Bob, we talked a lot last week about the potential for further regulation on large technology businesses in the US, and that was clearly newsworthy around Facebook. You've drawn our attention in your notes, though, to the pharmaceutical sector. Some parts of pharma will make money out of the global pandemic, others won't. Many are getting a lot of publicity and playing in the spotlight that this pandemic has rightly created for the sector. Will that be followed by positive momentum, or do you see regulation coming for that sector as well?
Well, I think, coming back to your first point, I think one theme for 2021 is going to be ongoing increased regulation and potentially taxation as well for the tech sector. And that potentially is a drag on what has been the top performing sector in 2020. Now, coming on to the pharma sector, I think the key issue for the incoming Biden government is pricing of pharmaceuticals. And I do think there is going to be increased regulation there. So it's basically in the consumer sector of healthcare that I think the Biden administration will increase regulation and trying to put a cap, on pharmaceuticals. So that again is something to watch. Now, having said that, the valuation of the healthcare sector at the moment is actually very reasonable compared to other sectors in the S&P. So price earnings ratios, well below the PE on the S&P, and that of course is one factor which is fueling this increase in M&A activity in pharmaceuticals.
I wonder what you expect the COVID fallout to be in the U.S. I mean, surely it's going to be horrendous in, obviously, Italy, Spain, the UK as well, all of which have more deaths per capita than the US, but not many more. And how is that going to hit the economy?
I think the hit to the economy we are already seeing, and that frankly started, as I mentioned, in November, and with very heavy restrictions in California, and most notably in Southern California, likewise in New York and certain other major cities such as Chicago. So, the economic fallout, obviously, it hits the service sector very hard. And, in Europe, we saw that over the last 2 to 3 months with that downward movement in the service sector PMIs. I think we're in a very interesting period at the moment whereby all the news on new cases for coronavirus out of the States and out of Europe are continuing to be very worrying. But conversely, in the States this week, the vaccination programs are being rolled out, and obviously they started last week in the UK, and I'm assuming that over the coming weeks we will see vaccination programs being rolled out across the rest of Europe. So we're in this sort of slightly odd period where the coronavirus numbers are bad, but the good news is that vaccinations are starting to be addressed.
Yeah, it's the short term and the medium term. Bob, thanks very much. Bob Barker, Quilvest Wealth Management Investment Committee member. Bob will be continuing his conversation with Matt and I on Bloomberg Radio at 9 a.m. UK time. Coming up here on Bloomberg TV, cruising into the future in a Bloomberg exclusive, we speak to the CEO of Zoox, the self-driving startup owned by Amazon, as it unveils its robo-taxi. We have that story next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open right now, 23 minutes into the session. We're looking at gains across Europe. You can see that banks are doing rather well, up more than 2% this morning. The pound is up more than 1% on increased optimism. Well, I guess optimism that we just danced past one more deadline on Sunday. Now, to matters further to the west, Zoox. The self-driving startup owned by Amazon has unveiled a fully functioning production robo-taxi. The company plans to deploy fleets of the self-driving carriage in its own autonomous ride-hailing service at some point. In an exclusive interview, Zoox's CEO spoke with our own Ed Ludlow about the challenges of getting the product to market.
This is one of those technologies where there's an advantage for everybody. There's an advantage for cities, there's an advantage in terms of transportation infrastructure. We're working very closely with both city level, state and federal level, and we are putting things together. Now, are there laws and things like that? Not yet, but as you can see already in Nevada and in California, driverless permits are being dispersed, basically.
There are other jurisdictions as well that are looking closely at autonomous vehicles, China being an example, some European nations. Could we see Zoox establish itself outside of the United States?
Yes, step by step, starting in the United States, but yes, we have global ambitions.
Do you think the public will be receptive to getting in a vehicle like that? It has no steering wheel, it has no pedals. You know, where is the momentum going to come from?
I think, again, it's safe, it's clean, it's enjoyable, building trust, even in the way we architected the vehicle, so that there's a contract with customers. They see what we're using to drive, i.e. the sensor pod and compute. And so it will take time, little by little, we'll earn it. We'll demonstrate our safety in a quantifiable way, but we think it's an inviting way to basically liberate customers to not worry about driving, parking, and all of those things, and just be transported. And what they do during that time that's liberated, it's also up to them in terms of entertainment, music, productivity.
Do you see a world in which people just don't own cars?
Not in the foreseeable future. We think it'll be a mix, but what we will see in dense urban environment, this vehicle is really built for cities. And it's really about efficiency. It's about overall societal benefit. And we think it will be a mix for a long time.
That was Zoox's
Hopefully we
CEO,
don't ever see a world like that.
Evans, there, talking exclusively to Bloomberg's Ed Ludlow on the company's ambitions for the future of its robo-taxi. I'm sure Matt Miller would get in it, no problem. I'm still trying to work out which is the front and which is the back, but maybe that doesn't apply when it's self-driving. Now, sterling is rising against all of its G10 currency peers this morning. The pound was sent higher after UK and EU leaders agreed to continue working on a trade agreement. But under the surface, there's still plenty of unease around the risk of a no-trade deal. Danny Berger is here to talk us through what is going on in the markets around this theme. And Danny, what are you spotting?
Well, Anna, look, this has been really a perennial problem for sterling investors. If you want to hedge, you end up spending money on options that once you get to these various deadlines, they just pass and nothing happens, rendering what you've spent more or less worthless. And I think the 1 week option on cable really explains this well. So the spike over here in March, for example, is when we saw the pandemic hit, and then you get this spike going into this weekend. It comes down, it eases now as these risks have still passed. But I want to point out, look, it still is relatively high. Also, options high when you look at the 1 month horizon. Anna, Matt?
All right, Danny, thanks very much. Danny Berger there talking about the pound. Michelle Barnier tells EU ambassadors a deal is still possible. That's why you see the gains today. Our Brussels edition is next.
welcome back to the European Market Open. 30 minutes into the first trading session of the week here for European cash equities, and we do see some upside, up 0.7% for the Stoxx 600. When we look at where these gains are falling, not so much in London. London a little bit weighed down by some moves to the downside in the pharmaceutical sector, with AstraZeneca, of course, making that play for Alexion. That is weighing on the share price. We see that stock under pressure. As a result, healthcare is the biggest falling sector. Technology also under pressure. Banks and insurance and retail, though, move to the upside broadly across Europe. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. Germany is entering a hard lockdown from Wednesday. Non-essential stores are closing. Employers are being urged to shut workplaces, and school children are being encouraged to remain at home. The tighter restrictions include a ban on gathering over the new year and will last until January 10th. It comes after a looser lockdown failed to halt a surge in cases. US government agencies have been hit by hackers. Cybersecurity firm FireEye says the attack came through an update to a widely used IT software. The Washington Post is reporting hackers backed by the Russian government are suspected of being behind the cyber attack. The US says it's aware of the reports and is taking all necessary steps. Iran plans to roughly double oil production in the next year. That's as the country anticipates a loosening of US sanctions under President-elect Joe Biden. Extra exports could cause problems for OPEC, which is trying to keep output down to bolster prices. The cartel has exempted Iran from production cuts due to US sanctions. British spy novelist John le Carré has died aged 89. He was best known for his Cold War thrillers, including The Spy Who Came In From the Cold and Tinker Tailor Soldier Spy. A former officer with MI5 and MI6, he wrote more than 20 books, tales of treachery, betrayal and duplicity. The New York Times once described him as the preeminent spy writer of the 20th century. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Matt, Anna.
Laura, thanks very much. Laura right there in London. Now it's time for the Brussels edition, your guide to the week ahead in European politics. At briefing envoys this morning, EU chief Brexit negotiator Michel Barnier says the two sides are still split on state aid, but he sees a, quote, narrow path to agreement. Let's get more with Bloomberg's Maria Tadeo, who has a guest for us. Maria?
Yes, Matt, good morning. So it's another day, another deadline that's come and passed, but Michel Barnier is still briefing, as we understand, European ambassadors saying it's difficult, but still possible. And to talk about this, we are now joined by Professor Pete Eickhout, who is professor at UCL of UK law and EU constitutional law too. So, Professor, I have a question when it comes to the deadlines, because as we know, this is becoming almost a never-ending story. When you look at the actual legal deadline, would that be December 31st, or do you see a way that talks can continue beyond and go into the new year?
Well, talks can always continue, of course, but December 31st is the deadline. That's the point at which EU law stops applying to the United Kingdom, and that new arrangements have to be found. This could, for example, also be, if a deal is reached just like a couple of days before that deadline, there could be a provisional application of that deal. But the old state of the law, which was the continued application of EU law throughout the transition, that definitely ends on the 31st of December. And that means a lot of change in all aspects of economic relationships.
Right, and I want to pick up on that because the timeline is crucial here. So what you say is there could be a deal by December 31st that's not ratified, but would still be applied nonetheless. And what happens in the meantime? You know, if the leaders agree to a deal, but the European Parliament doesn't ratify that deal until, let's say, January 15th, what happens in those 15 days? There's a lot of uncertainty for business.
Well, so the trade side, the pure trade side of a deal, which would be, for example, the fact that there are no tariffs and no quotas, which is what the deal would include, that can be applied provisionally, and that doesn't have to be necessarily approved by the European Parliament. It can be done by the EU Council of Ministers on the EU side, who can decide to provisionally apply the agreement and give more time to the European Parliament, for example, to look at the agreement and to get it finally ratified. That's the position on the EU side.
Right. So there could be a bridge, a legal bridge in between that. But I do want to clarify something, because I do hear there's been a lot of speculation that perhaps we could enter a no deal, then the European countries would then negotiate on a one-on-one basis, or could be a series of mini deals. Is that doable from a legal perspective?
Well, the law is complicated, and there's a political element as well, of course. It does seem pretty clear that the EU and the EU member states are really keen on remaining united, also in the new year, in the event of no deal. So there might be legally scope for doing mini deals between the UK and individual member states, particularly the ones who are closest and, which constitutes the trade border. But whether those states will be willing to do so is really rather unclear. The position seems to be that they will want to continue negotiating through the EU and the European Commission.
Okay, and Professor, there's a question I want to put to you on this concept and this idea of sovereignty. The Spanish foreign minister yesterday said something that was really interesting, in which she said, when you look at a trade deal, this is about dealing with the interdependence that you have. It's not about asserting your independence. That's by definition not doable in a trade deal. How do you get around the two? The Prime Minister is clear that he wants something in the trade deal that makes it clear the country is independent. At the same time, you have to manage the trade relationship. What's the legal leeway there?
Well, I mean, it's finding that balance between maintaining your sovereignty and cooperating with others. I mean, obviously, when you commit to cooperate with others and you make that legally binding, you limit to some degree your sovereignty. I mean, that's indisputable. I'm sure the UK government would recognize that as well. I think it's really about finding that sort of balance between how much sovereignty the UK wants to keep and how well it wants to manage the interdependence. And of course, no deal would mean kind of absolute sovereignty in the relationship with Europe, because there wouldn't be any commitment other than the withdrawal agreement, which was concluded last year. But obviously, it would also mean that the interdependence would be very difficult to manage, and that each side would simply apply its own rules, which would make everything a lot more difficult.
Right, and the Prime Minister says, deal or no deal, the UK will do well. When it gets to January 1st, this is not going to be doomsday. It's not going to be chaos. From your perspective, when you get to January 1st, given all the uncertainty that we know there is already and exists already, what does that look like?
Well, I'm not sure. I'm a law professor. I'm not an economist, but I'm worried about it. I'm worried also about the kind of unknowns, the things which might happen, the sort of negative cycle which might be started by the fact that the relationship sort of breaks down, that trade becomes immensely difficult. This may have an effect on investment. It may be run on the pound. I mean, I don't want to go too far myself in thinking of this doomsday scenario, but it is something, it is something which starts on the 1st of January, which I'm not sure anyone really has a full sense of what it might result in and what kind of economic consequences might gradually develop. So we've seen that crashes are possible. Right.
Right.
We'll just have to wait and see.
Right. So we'll see whether or not it's doomsday, whether or not we can get to a deal before that. Professor, thank you so much for joining us. That is Piet Eickhout, professor at UCL of UK law and European law 2, joining us on Brussels Edition. Another week that we're talking about Brexit. Anna?
Yes, Maria, it's sent to test us. The Irish Prime Minister, I see, is saying that the real end deadline is New Year's Eve, a point we've made many times. But of course, they're hopeful of a Brexit deal, and there is pressure. The Irish were saying over the weekend, there is real pressure now to do something in the next few days. Maria Tadeo in Brussels, thank you very much. Coming up on the programme, Angela Merkel takes Germany into a hard lockdown until January. The Chancellor blames Christmas shopping for the recent rise in cases. What will that mean for the economy? We'll get analysis next. This is Bloomberg.
Wir bleiben bei den persönlichen Kontakten dabei.
We maintain that friends, relatives, and acquaintances can meet with a maximum of 5 people and 2 households, and there is an exception only over the Christmas holidays from December 24th through 26th, but not on New Year's Eve and New Year's Day. This exception means that you can invite 4 more people beyond your own household.
All right, Angela Merkel, they're announcing a hard lockdown and really giving us the holiday details. Clearly, the German government is more concerned that people will party hard on New Year's. So they're allowing you to gather on Christmas, but not for the New Year's celebration. Most importantly, from Wednesday, all non-essential shops will be closed. And these are the crucial days for a lot of retailers to make it to profitability before the end of the year. A group of retailers, in fact, wrote to an open letter to Merkel, and it was published in the Bild Zeitung, saying they're going to be a cascade of bankruptcies because of this. Joining us to discuss further is Carsten Breschke, ING Chief Economist, Germany. Carsten, what do you think this is going to do to the German economy, most importantly, I guess, to the retailers here if they can't sell anything in the crucial week before Christmas?
This is an enormous hit to the German retailers, and I think now with this hard lockdown, the double dip has clearly become inevitable. At the start of the fourth quarter, we still had good numbers out of the manufacturing sector. Services were already suffering, but now with these lockdown measures, there will be an enormous hit to the entire economy. And I think retailers are right. This is their season of the year, and also the days after Christmas are their season of the year. So they will take an enormous hit.
How is, well, or is the German government going to be able to bridge this lockdown? Are they going to be able to give enough money to these retailers that there won't be a slew of bankruptcies?
At least this is what we heard from the government, and then the government, announced that they will, I think, pay up to 500,000 euro, depending on all kind of complicated criteria. So yes, there will be a bit of a compensation, but to really make up for the crisis, also, this means that all the retailers will go on an extremely weak footing into next year, and even if this lockdown is supposed to end by January 10th. I think everyone knows that this will not be a return to pre-lockdown times afterwards. So this period of uncertainty of on and off lockdowns will continue throughout the first quarter.
Yeah, good morning to you, Carsten. Before we got this news over the weekend, the Bundesbank was talking about a bit of a setback over the winter, but then a rebound in the second quarter. Is that the timing that we're still looking at here? And if we see a bigger dip in the winter, we get a bigger Q2 rebound?
I think, yes, that is still the pattern we're looking at. Obviously, everything is so much depending on the vaccine and the rolling out of the vaccine, which will only start in the course of January, given that this European Medicine Agency still have to give its green lights to roll out the vaccine in Germany and other European countries. It only means that this soft patch is no longer a soft patch, but it's going to be really a very hard winter for the German economy. So contraction in the fourth quarter and only a very mild rebound depending on the weeks in late January and February will take, and then only with springtime, better weather, more people vaccinated, then we will see a taking off of the economy again.
I'm already dreaming of springtime, Carsten, but if I think a little further ahead, do you see signs that the German economy is transforming itself to take account of recent global dynamics? I'm thinking about deglobalization, whether you really see that as a big driver over coming years, and how resilient the German economy can be to that.
I think Germany has a very good starting position, giving all the fiscal stimulus that was used to support the economy. But what we just discussed, the retailers nicely show that this is also a sector which did not go full into digitalization. So there is no alternative. So Germany has to continue very quickly going out of this crisis, having a good starting position to accelerate investment in digitalization, sustainability, fight against climate change, continue with the transition of the manufacturing industry. So there is still a lot to do. I think the biggest achievement, if you want to, for this year is really that 2020 was the U-turn on fiscal policy in Germany, and if they continue with positive accommodative fiscal policy in the next years, then I think we can be hopeful that Germany will master this structural transition.
Carsten, you're an economist, not a political analyst, but you're not unfamiliar with the political ramifications of these moves. Not only is Merkel shutting down stores a week before Christmas, but she's essentially forbidding people from partying on New Year's Eve, and we won't be able to shoot off the traditional fireworks. How hard does this hit the CDU ahead of such an important election year?
I think right now, especially Merkel has very high ratings. So I think the majority is still really kind of supporting Merkel. It will now really depend on how we get there. I think people you might not be able to do without fireworks, but I think the majority of the Germans can do if at least by mid-January the situation will really improve and we get an easing of the lockdown measures. I think the longer this uncertainty, the longer this on and off lasts, the more the damage will be for the popularity of the CDU and the SPD. But currently, especially Merkel is so popular that there are even voices asking why wouldn't she run for a fifth term when it comes to the elections in September.
Okay, yeah, Matt's going to have to save his fireworks for another occasion, isn't he, Carsten? Thank you very much for joining us. Thanks for bringing us your perspective. Carsten Bresky, ING's chief economist for Germany. Quick check on the markets then. European equity markets just coming up to 50 minutes into the trading session for this Monday morning. We've got a move of 0.7% to the upside on European stocks, essentially. A lot of movement around that midpoint, though. The banking sector doing pretty well, and a lot of that being lifted by optimism around a Brexit deal. That also lifts the pound. The banking stocks in the UK doing very well, and the pound doing well, up by 1.3%. Still around that 134 level. I'm sure we were around that point this time last week, but we'll get into a conversation about the markets. We'll talk to Market Live's Eddie van der Walt. He's going to join us next to talk about those themes and everything else moving markets this Monday morning. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are 53 minutes into the session right now and looking at green arrows across the screen. The DAX up 0.8%. The CAC 40 gaining 0.75%. The FTSE not as much. It is up, but only 0.1%. But that's because of the strength of the pound. It's holding down to some extent the benchmark index. European stocks, though, in general, up as the extension to Brexit talks offsets the introduction of a hard lockdown in Germany. There could be other factors at play as well. Joining us now is Eddie van der Walt, Bloomberg MLive European strategist. So, Eddie, what is it that's, you think, the impetus behind the gains that we're seeing? It can't be, it can't be that investors are so happy another deadline has passed that they're out buying German, French, and Spanish stocks in size.
I think, I think if there's one thing that 2020 reminded us of is that markets are extremely forward-looking because there's a lot, on the face of it, there's a lot to be worried about. Brexit still unresolved, Germany re-entering lockdown, Italy talking about new measures, New York's halting, all these are worries in the near term. But when you look at markets historically, markets come out of a recession rallying. That's what they do. They look forward to the growth that's coming, and that's what we're seeing here. And plus, there's a bit of Santa rallying going on. I think people are just a little bit more optimistic going into the end of the year, saying, look, we're going to put all of this behind us, and next year is going to be a better year.
Yes, and maybe, well, let's see what anyone gets for Christmas this year. We seem to be getting a rise in bank stocks as we run into Christmas. Then, Eddie, maybe that is the Santa rally, because certainly in the UK we're looking at the FTSE 250 doing better than the FTSE 100. You'd expect that with the move in the pound. The Lloyd's share price goes higher. NatWest goes higher. It seems that things that are geared towards the domestic economy are looking more optimistic. Where do you stand on the Brexit narrative?
Yeah.
Then? What are you watching for as the pound flirts with that 134 level?
Oh, I had a complete breakup. I'm not hearing you.
The pound. She's saying, what are you watching for as the pound goes through 133?
Oh, yeah. I mean, look, the pound. So the pound. Yes, we're sitting at the top of that range where we've been recently. We're sitting, near the highs of 2018, or rather, sitting at levels almost seen last in 2018, and it almost feels like, the pound is waiting for that big move. Either we get resolution to our problems with Brexit, or we don't. And, so we're going to see a big move in the pound one way or another, it feels like. And that obviously will impact the FTSE, but really for me, the small caps are, in the UK are even more important.
All I want for Christmas, Eddie. Thank you very much. Thanks for joining us.
Thank
Eddie
you.
van der Walt, Bloomberg Markets Live European strategist. Apologies for the breakup in the communications there. 56 minutes then, Matt, into the European trading session, and we're making some headway for European stocks. We need to remember, of course, the US stimulus story seems to be playing a part here.
Yeah, the U.S. story, definitely, whether or not we get stimulus or not, that typically rolls around the world. But the Brexit issue and the movement of the pound, I think, is very important to think about. For me, there's this huge conundrum, right? Because if there's a no deal and the pound crashes against the euro, I can more easily buy that Ducati in Sheffield that I want. But then I'm going to have to pay like 20% to import it here to Berlin. So an issue we're going to continue to keep covering, no doubt. This is Bloomberg.
Another shot. Boris Johnson and Ursula von der Leyen extend Brexit talks with yet another deadline ignored. A tough winter. Germany enters a hard lockdown this Wednesday as Italy overtakes the UK for coronavirus deaths. Plus, AstraZeneca lands a $39 billion mega deal to take over Alexion Pharmaceuticals. It's the company's biggest deal since it was founded. Well, good morning, everyone, and welcome to Bloomberg Surveillance. Happy Monday. I'm Francine Lacqua here in London. Now, the market's definitely focused on Brexit. There seems to be a bullish tone, certainly more than it was on Friday, not only on Brexit, but overall on a possibility of stimulus in the U.S. So if I look at what exactly we should be watching out for in the markets, European stocks, you can see, are gaining some 0.8%. The pound is also surging. I have to say, investors seem to be taking comfort from further stimulus bill negotiations, but also the impending deployment on the first vaccine in the U.S. Now, we'll have plenty more, of course, on that throughout the day. Now, let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Thanks, Francine. Germany is entering another hard lockdown from Wednesday. Non-essential stores are closing. Employers are being urged to shut workplaces, and school children are being encouraged to remain at home. The tighter restrictions include a ban on gathering over the new year and will last until January 10th. It comes after a looser lockdown failed to halt a surge in cases. U.S. government agencies have been hit by hackers. Cybersecurity firm FireEye says the attack came through an update to a widely used IT software. The Washington Post is reporting hackers backed by the Russian government are suspected of being behind the cyber attack. The U.S. says it's aware of the reports and is taking all the necessary steps. Iran plans to roughly double oil production in the next year. That's as the country anticipates a loosening of U.S. sanctions under President-elect Joe Biden. Extra exports could cause problems for OPEC, which is trying to keep output down to bolster prices. The cartel has exempted Iran from production cuts due to U.S. sanctions. British spy novelist John le Carré has died aged 89. He was best known for his Cold War thrillers, including The Spy Who Came In From the Cold and Tinker Tailor Soldier Spy. A former officer with MI5 and MI6, he wrote more than 20 books, tales of treachery, betrayal and duplicity. The New York Times once described him as the preeminent spy writer of the 20th century. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Thank you so much, Laura. Now, staying with our top story, and Brexit talks have been extended. The UK Prime Minister Boris Johnson and European Commission President Ursula von der Leyen agreed to go the extra mile and keep working on a deal. The pound jumped on the news. Now, for more on all of this, we're joined by Ed Evans, our Brexit editor. Ed, how likely are we now to get a deal? Because, another extension is usually for something.
Another extension is usually for something. I think the important thing here is Sunday was a point at which the talks could have fallen apart, and they didn't. It was the deadline that they were going to decide on whether to go on talking or to actually walk away. And what's clearly happened since Wednesday's frankly disastrous dinner between Boris Johnson and Ursula von der Leyen is that both sides have looked over the precipice and have taken a step back. And you're beginning to see now the contours of a compromise on the level playing field and on fisheries. Now, those were the two big obstacles to a deal, and it looks like they're taking a step closer to resolving those, and they want to do that over the next few days. Obviously, the one deadline in all this that won't change is December 31st, and it's a rather small number of days until we get there.
Ed, is it both sides giving in or both sides compromising, or will one side lose more?
It looks like on both sides. The key bit here is on the level playing field. And essentially the question is, what action can the EU take if the UK decides to go its own way and have different environmental, social and labour rules? The EU's initial ask was to have immediate rights of preemptive retaliation. It could impose tariffs immediately. It now looks as though they're backing down and they're prepared to impose some form of arbitration and dispute resolution before they can do that. Now, it looks as though the UK might agree to that. Now, then you get into the debate on fishing. Now, that is an argument about numbers and species, and that is essentially haggling over numbers, and that's a sign that you really are getting into the final stages of these negotiations.
Great. Thank you so much for the update. Ed Evans, of course, who oversees all of our Brexit coverage. Now, joining us now is Michael Strobeck, Global Chief Investment Officer at Credit Suisse. Michael, there's a lot of things to talk about. We'll talk about the U.S., we'll talk about 2021, but overall, does Brexit matter to your portfolio allocation?
No, not a whole lot, Francine. I think, look, we've been learning to live with the Brexit saga for almost 3 years now. It does matter, of course, for UK assets and the pound, but in general, for the outlook in Europe and the world, I have to say, no, it doesn't matter that much.
So what matters to you the most? Is it vaccine? Is it resource allocation? Or is it herd immunity?
It is honestly, number one, central bank and central bank support that we continue to need, because we still have some uncertainties in the near term about a stimulus, the size of it. Secondly, of course, the vaccine news is great, but I think we just all have to be realistic that it's going to take time before that whole thing is rolled out. I don't hope we're going to get a third wave of this virus before we have a vaccine rolled out, but it doesn't look particularly good in many countries. Germany going back into lockdown, Switzerland, where I sit, situation not great either, and the US with nobody really at the helm. We have 2-3 difficult months ahead of us, and I think those uncertainties are more important than Brexit or anything else.
But Michael, when you look at central bank support, so I guess the biggest question is whether inflation's coming. Given what we've known so far, even if we were to have a vaccine that works at the middle of next year and we reach herd immunity maybe third quarter of next year, what's the likelihood that actually pushes up inflation?
Well, that is the big risk factor that we also see. But we do see that the most imminent sort of issue is actually what does that mean to yields? I mean, if we have a strong recovery, which we expect next year, combined with surprises to inflation expectations, not about actual, but if the market gets scared about inflation expectations in general and say we have turbocharged our way into 2021 with stimulus, with growth, and also pent-up inflation expectations, that's the real risk for markets. I don't have that as a main case. We're still sort of decently, cautiously risk on in equities, emerging equities, credit on the emerging side as well. But it is the number one economic risk that I think is out there for markets is surprise inflation expectations.
Is that priced into the markets, Michael, or some of the concerns out there, or is it being ignored?
No. It is not at all, in my view, priced. I think what we're seeing now is potentially a bottoming of real yields. With that and derived from that, actually inflation expectation could be flawed as well, and therefore there may be a risk out there for, say, mid next year. It is not priced into markets, and if there's something I'm concerned about, is sort of a little bit that we're in this 2017, 2018 scenario where everybody felt we had a fantastic rally, everybody's bullish, everybody says risk on, we're going to come out of this, and boom, yields go up more than we expected, mostly because of inflation, as happened in February 2018. And guess what? That will also reset central bank thinking, because the number one thing they don't really need now is rising inflation expectations.
But Michael, what does it mean so how do you adjust your portfolio to take all of that into account?
Well, first of all, you have to just be realistic and say, look, you have to be risk on. There is huge pent-up investment demand across the entire institutional world. Many long-only investors have completely missed this rally. They want to get on it. They want to get into it. They're looking for dips. These dips are very shallow. We saw September, October ones being more meaningful, but we're steering into the year end with still tons of liquidity on the sidelines, and I would not be on the wrong side of that, and still be pro-risk, but just have as a risk scenario, you need to be short duration, you need to prepare for steepening yield curves, and play it more with an asset allocation shift out of bonds and into equities.
Michael, what do you do with healthcare? So we'll talk about AstraZeneca in a second, but is this industry going to go through massive disruptions in 2021, or have we already seen like peak valuations?
I think, look, given what has happened in 2020, healthcare and the healthcare sector has been reset. And I think you'll see huge new investments, M&A activity into this sector to prepare for something similar to COVID in the future. Immunology, study of viruses, vaccines, and so on will be a mega trend for years to come. I mean, let's be honest, the reason why we're coming out of this hopefully faster than we thought on the vaccine front was that the healthcare sector has been preparing for this for 20 years, but they didn't have the virus to get ready for, and now they have it. That's why we are so fast into this. But I think this is just at the infancy of developments, and therefore I would secularly be long healthcare for sure.
All right, Michael, thank you so much. Michael Strohback there from Credit Suisse stays with us. Now, in the meantime, we did have that news about Alexion and AstraZeneca, so let's check the share price. Alexion would be pre-market. If we have that for you, it'll come shortly. Now, if you look at Alexion shares, they were up some 32% after the AstraZeneca deal. I don't know if we have AstraZeneca. It'd be great to also look at that because shares were slumping after this $39 billion deal for Alexion. Now, coming up, we talk about the rollout of vaccines and what it means for investments and markets in 2021. That's coming up next, and this is Bloomberg.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, we're just getting some breaking news out of Singapore. Of course, we're on vaccine watch. This is probably the most encouraging story in the last couple of weeks and months, that vaccines are being rolled out, that a lot of countries have access to these vaccines. On the flip side, we're also seeing a lot of countries having to go into more lockdown measures because of concerns that cases are rising. Now, Singapore, just moments ago, saying it has approved its Pfizer-BioNTech vaccine, arriving by the end of the year, and they also put a very encouraging statement out saying that they should have enough vaccine for the whole of the population, for the whole of the country by the third quarter of next year. Now, over in the U.S., hospitals are preparing to receive the first shipments of the Pfizer coronavirus vaccine. Healthcare workers and nursing home residents will be prioritized. Cases are surging in the U.S. with total deaths nearing 300,000. What will the rollout of the vaccine actually mean for markets and investments in 2021? We're back with Michael Strobeck from Credit Suisse. Michael, we were talking a little bit about this before, but once we have a vaccine that is, sufficiently rolled out, do we go back to worrying about other things such as trade war? What kind of relationship will the U.S. have with China?
Yes, I think we will do that, Francine. It will take, however, 3 quarters to get this rolled out. There will be logistical issues in between. There will be sort of scares about, is it safe, is it not safe? Not everyone is going to take it either. All these things we pretty much know. The good news about these vaccines that are coming out is they're highly effective and they've come out very fast. I think the markets have looked through pretty much all of that, bearing some unknown on the vaccine front, and we'll begin looking towards when can we be back at normal levels on economic growth. And critically, what are the central banks going to do when all of this is rolled out? We're sort of moving back to normality. The number one question is, when will they start pulling back the stimulus that they put into the system that has been nothing short of massive? And this is what to watch for, and their language on that. This China-US issue will be here with us for the next decade or more. But I do believe the number one tone will be set by the central banks again next year, and it's a question of how much further are they going to go with the stimulus.
But Michael, overall, if you look at fundamentals in the economy, even if we have a sharp rise in GDP, we have to go back to the levels that we would have had before had there not been a pandemic. When do equities actually match up with fundamentals?
Oh, I think they've discounted, Francine, all of that one year out already, and I'm not convinced at all that this gap is in and of itself wrong. Equities look 9-12 months out, and they're seeing a bright recovery. They're seeing the pandemic going away. They're seeing the central banks having put in historical stimulus that they can't take out very fast in its size, because if you compare it with what we got after the financial crisis, we had 3 to 4 times as much. And what the learning in the last 10 years was that it takes half to a full decade to get it away. And this is what will occupy markets. Secondly, yields. They are not going to be able to raise interest rates at the short end for sure for the next many quarters, if not few years, simply because the level of unemployment that has been created by the pandemic in the Western world, and they have 2 things on the horizon for central bank goal setting: that's growth and it's unemployment, and that is not going to go away very fast either. So they are in this sort of catch-22 as to how much further do we actually allow risk assets to run. And there, the message has been, we don't care that much about the levels. Powell said that very early in this pandemic. We don't care much about asset pricing levels, because maybe they know what the right level is, maybe not. But they say we care about unemployment and we care about growth, and those are the key things that they will watch. And I think for as long as this is the backdrop, you've got to be into real assets, equities, steering into private market opportunities, hedge funds, private equity funds, et cetera, because those are the only sort of real return plays in town now that the return in fixed income, certainly government bonds and short cash has been taken away.
But Michael, there's places or things I would call, maybe industries, that are in a bubble. Do you worry that some of these valuations, frankly, are crazy, and that when it bursts, that bubble, it brings the rest of the market down with it?
No, I don't worry about that too much, Francine. I do believe that there's some valuations that are excessive, but still, if we compare what we have today with what we had in 1999, 2000, we're in a different world. The tech world is solidly footed in, also because of the pandemic, with a business model, global business model that has just worked fantastically. And we have just to be honest that without that, we would have been in a dark place. I don't see the valuation there as excessive. It doesn't mean that I would necessarily now, given this rally, be overweight there. And we actually closed our overweight in tech a few months back. Everybody is looking for the 2 big rotations. And those are growth to value and bond to equity. And maybe 21 will be the year when we sort of see this beginning to unfold. It will also mean out of the US more, into Europe, into emerging. I see sort of early signs of that, and therefore I would just not play too heavily on the tech rally continuing, but more start picking up the cheap stuff, picking up the cyclical stuff, picking up the well-priced stuff for the growth. And that is really mostly in Europe, like in Germany, it is in Asia, like in China, and it is overall more and more away from just US-focused assets like tech.
Michael, if there's something that you're buying right now as a precaution, what would it be? Is it gold? Is it Swiss franc? Is it yen? Is it something else?
Well, for sure, I think gold can continue to go. I mean, we have a sort of 2,200 type target for gold. I think it's a good hedge. I have to say, plain vanilla protection, put protection has also gotten cheap. And lastly, I would bet into more safe haven assets, Swiss franc, yen. Believe it or not, we actually like the euro as well as sort of good hedges and or good plays against the weakening dollar in a portfolio context.
Thank you so much. Michael Strobeck, their Global Chief Investment Officer at Credit Suisse, of course, with some of the things that you want to be invested in 2021. Now, coming up, we speak with the NatWest Group Chairman. He's Howard Davies. That's coming up in about 30 minutes from now. We'll talk about vaccines. We'll talk about the banking industry. And, of course, we'll talk about Brexit. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Thanks, Francine. AstraZeneca is buying Alexion Pharmaceuticals for $39 billion, pushing into rare diseases and immunology. The deal values Alexion at 45% premium to its Friday closing price. It would be the largest deal for AstraZeneca since 1999. Amazon's self-driving startup Zoox has unveiled a new fully autonomous electric vehicle. It doesn't have a steering wheel and can drive day and night on a single charge. We spoke to the company's chief executive.
Not only do we have the capital required, we have the long-term vision, the ability to focus and execute. And this is really about reimagining transportation, really. And so it gives us a baseline to build from and then expand on.
Business Flash, Francine.
Thank you so much, Laura. Now, coming up, we'll be speaking to Paolo Gentiloni. He's the European Commissioner for the economy. That conversation, of course, will be on Brexit, on the EU Recovery Fund, and climate change. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Thanks, Francine. Singapore plans to ease its virus restrictions on December 28th, allowing up to 8 people to gather. It has approved the vaccine by Pfizer and BioNTech and expects the first shipments by the end of the month. The country has set aside more than $750 million for vaccines and expects more of them to arrive in the coming months. The UK and EU are giving negotiators another shot to agree a post-Brexit trade deal. Talks are continuing past Sunday's deadline, with the two sides vowing to go the extra mile. They haven't set a new target date, but on December 31st, the UK will leave the EU single market and customs union with or without a deal. A bipartisan group of US lawmakers plans to unveil a $908 billion pandemic relief plan today. In a bid to break the deadlock, lawmakers will present language for two separate bills, a stripped-down version without state aid and liability protections for businesses, and a second bill that contains the two provisions that have divided Congress. Italy has overtaken the UK as the European country with the highest number of COVID-19 deaths. Italy is among the countries hardest hit by the pandemic, with more than 1.8 million cases. European Council President Charles Michel expects the first vaccines to be approved in the EU in the coming weeks, maybe even before the end of the year. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg Francine.
Thank you so much, Laura. Now, Zoox, the self-driving startup owned by Amazon, has unveiled a fully functioning production robo-taxi. The company plans to deploy fleets of the self-driving carriage in its own autonomous ride-hailing service. Now, in an exclusive interview, Zoox chief executive spoke to our Ed Ludlow about the challenges in getting the product to market.
This is one of those technologies where there's an advantage for everybody. There's an advantage for cities, there's an advantage in terms of transportation infrastructure. We're working very closely with both city level, state and federal level, and we are putting things together. Now, are there laws and things like that? Not yet, but as you can see already in Nevada and in California, driverless permits are being dispersed, basically.
There are other jurisdictions as well that are looking closely at autonomous vehicles, China being an example, some European nations. Could we see Zoox establish itself outside of the United States?
Yes, step by step, starting in the United States, but yes, we have global ambitions.
Do you think the public will be receptive to getting in a vehicle like that? It has no steering wheel, it has no pedals. You know, where is the momentum going to come from?
I think, again, it's safe, it's clean, it's enjoyable, building trust, even in the way we architected the vehicle, so that there's a contract with customers. They see what we're using to drive, i.e. the sensor pod and compute. And so it will take time, little by little, we'll earn it. We'll demonstrate our safety in a quantifiable way, but we think it's an inviting way to basically liberate customers to not worry about driving, parking, and all of those things, and just be transported. And what they do during that time that's liberated, it's also up to them in terms of entertainment, music, productivity.
Do you see a world in which people just don't own cars?
Not in the foreseeable future. We think it'll be a mix, but what we will see in dense urban environment, this vehicle is really built for cities. And it's really about efficiency. It's about overall societal benefit. And we think it will be a mix for a long time.
Zoox's chief executive, Aisha Evans, there talking to Ed Ludlow on the company's ambition for the future of the robo-taxi. Now, coming up, AstraZeneca plots its post-COVID future with a $39 billion deal. We discuss that next, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Singapore has approved the Pfizer-BioNTech vaccine with the first doses available by year-end. AstraZeneca, meanwhile, has been plotting its post-COVID future with a $39 billion deal for a rare disease specialist, Alexion Pharmaceuticals. But news of the deal also sent the shares tumbling to an 8-month low. The stock was already under pressure amid questions over the efficacy of its potential COVID vaccine. Well, joining us now is Sam Fazeli, Bloomberg Senior Pharmaceuticals Analyst and Director of Research of EMEA. Sam, first of all, good morning. Why did AstraZeneca feel they needed to do this deal?
Good morning, Francine. So it's actually a bit of a surprise to me, at least, and I think obviously, as you can see from the market reaction in the market too. But you know, this is a company that was growing the best growth rate of any large pharma out there, and then they announced this deal. To me, it's basically a financial thing. It's almost it's issuing shares to buy cash flow for the future. So, you know, and they're buying a decent stream of cash flow until at least 2025. And they've got a highly rated paper. They're using that to buy a much lower rated paper. So to me, it's just a financial thing. And also the products that they're buying fits.
So, Sam, overall, like, where are we on the vaccine for AstraZeneca? I know there was also some very controversial, you know, story about AstraZeneca also looking at the Russians for the vaccine. What exactly are we?
Yeah, I mean, let's not forget that Russian or Chinese, these are developed by scientists and local companies, and doing combination studies is something that we should be doing anyway, that I think UK had started talking about. But that combination that the UK had talked about was the AstraZeneca vaccine, potentially with the Pfizer vaccine, not in one shot, but one after the other. So that's still, these are all some things to be explored. But where we are with the vaccine, there's no new information apart from what we saw that was published in the Lancet last week. And that really didn't change anything for me. If anything, it added a few more questions that I need to see another trial report before I understand what's going on with this vaccine. But we do know it works. It's just how well it works is very tough to tell.
Sam, we're also hearing, of course, from Singapore that they've reached a deal with, you know, a vaccine maker, and they'll be able to inoculate, I think, most of the population, if not all of the population, by the third quarter of 2021. What happens to the countries that don't have enough cash? What happens to the ones that are not rich? Who are they talking with?
Yes, so there is an organization that has involved Astra, has involved the UK government, COVAX, which involves the Gates Foundation, I think, also. They are procuring doses to donate to countries who do not have the financial wherewithal to afford to buy the vaccines in the market at the prices that they're being offered. So how large that pile of doses for COVAX will be obviously depends on the continued success of the various vaccines that have yet to read out. And we have at least, well, we need to know more about Astra, and then we have Johnson & Johnson and Novavax coming up quite soon.
Sam, thanks so much. Bloomberg Senior Pharmaceuticals Analyst and Director of Research for EMEA, Sam Fazeli, joining us this morning. Now, the 7th Rome Investment Forum is also underway today. The conference focuses on investment as a long-term driver of development and economic growth, and will be taking place virtually this year. Our own Guy Johnson is speaking to Paolo Gentiloni, European Commissioner for the Economy. So let's listen in.
Well, the initial idea was to have the first approval of these plans in late spring. I think this was the idea of the decision taken at the end of July, when for the first time the European Council approved the proposal of the European Commission. Now, finally, last week we had the final decision, and I think that this timeline, I mean, late spring or maybe beginning of the summer, could be indeed implemented. As you know, the first approval will come from the European Council with a vote with qualified majority. And after this approval from the European Council, based of course on a proposal from the Commission, we will disburse the what we call a pre-financing, so the first disbursement, and this will be in the Council proposal 10% of the total amount, which is more or less for Italy 20 billion. But there is a discussion that I hope will be concluded tonight. The Parliament is asking to make this 10% higher. We will see what the landing zone could be. So first disbursement will come, I think, according to the timetable that we decided in July, late spring, beginning of the summer. Of course, it's a big challenge because, as you very well know, this means also for the European Commission to issue a common debt. We already had a very good experiment with this SURE mechanism, raising 41 billion in the markets in November and December. But of course, the European Commission will become a big issuer of public debt denominated in euro. And also this, I think, will have consequences for financial markets. Good one.
Well, yes, the initial toe in the water was extremely well received by the financial markets, heavily oversubscribed. So just to refer back, so Italy, if we're being specific, is currently on track. Italy is not running late.
No, at the moment, nobody's running late because we were a little bit late in the final approval that came last week because of these political problems that we faced. But now we received draft or framework of these plans from a dozen of member states. I'm sure that in January we will receive almost every member state's draft, and then the final versions of these programs will be presented in spring for the approval in the timeline that I mentioned before. So I think that the general framework that the Italian government presented to the parliament is a broadly converging with the European messages and priorities, but of course we have to look at the single projects and the reforms and the commitments when the draft plan will be indeed presented.
Commissioner, some have suggested that this fund should become a permanent part of the economic arsenal that the Commission and the European Union can deploy. What are your thoughts on this?
Well, I totally share the enthusiasm that I think is a right one for the decision that has been taken, really an unprecedented one. And but I know that several leaders referred to a Hamiltonian moment, a Copernican moment, a Rubiconian moment, etc., etc. Okay, this is something that we will maybe define in 10 years from now. At the moment, we have an unprecedented decision, but we know for experience, the experience of the building of the European Union, then if it works, it can be repeated. So I think that our main task now is not to define this as a permanent mechanism, but to make it work. If it works properly, I think there is, as all our history shows, the basis to use the same method for new emergencies. But this is not a decision that has already been taken. This fund has been decided as an extraordinary one-off decision. I repeat, if it works, we will repeat it.
Okay, let's talk about what needs to happen for it to work. First of all, do you worry that bureaucracy, that corruption will prevent countries, for example, Italy, spending this money effectively? Do you think they have the necessary tools to be able to deploy the money effectively? What also help can you provide to make sure that this all happens?
Yes, indeed, I think we have two main challenges. One is the content of these plans, because the very fact that Europe has a plan, meaning that we have shared priorities. And these priorities are, first of all, the Green Deal. I've heard the Italian Prime Minister referring to this, and rightly so. And let me only mention the fact that the EU decision, which was a defining decision for this von der Leyen Commission, to try to have a leadership, a global leadership on the Green Deal, is not now a solo journey, because in recent months, other countries, we had the American elections, we had commitments, of course, with some contradictions from China, but also from Japan, South Korea, South Africa. So I think it will be a real new Green Deal commitment at the global level, and Europe will have the advantages of the first mover. So in one side, we have the mission, the priorities, the digitization, the Green Deal, the modernization and resilience of our societies. On the other side, you were saying, and it is absolutely correct, we have the problem of the execution, implementation. We know that several member states, including Italy, have a tradition of difficulties in absorption of European funds. And these difficulties will be multiplied by the amount of money in a short time in next years. So we strongly recommend to take note.
That is Paolo Gentiloni, the European Commissioner for the Economy, speaking to our Guy Johnson. Of course, you can follow the conversation on the Bloomberg terminal. Now, coming up, renewed hopes, sterling jumps as the UK and the EU extend Brexit talks. But with less than 3 weeks until the deadline, will we get there? More on that next. And this is Bloomberg.
Order placed to sell short Canadian dollar at 127.5. Okay, position opened, short position 127.5. Okay, guys, you can see.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, sterling is rising against all of its G10 currency peers this morning. The pound sent higher after the UK and EU leaders agreed to continue working on a trade agreement. But under the surface, there's, of course, still plenty of unease around the risk of a no-trade deal. Here with a look at what is going on is our markets reporter, Danny Berger. Hi, Danny.
Hi, Francine. Well, yes, we have seen some of the hedging calm down from where they were on Friday. This yellow bar is where it was on Friday. So the 1 week options of protecting against drops in the cable has somewhat cheapened, somewhat eased. But it's important that this right at the moment is about double the average we've seen over the past 12 months. And the issue with these short-term options is we see traders go in hoping to hedge against a deadline, but those deadlines come and go, which means if you've bought protection based on these options, it was more or less money wasted. And now without any real clear cutoff for when the talks will end, perhaps where we continue to see the most stress is in 1 month risk reversals on cable. So again, this is a form of how much are traders hedging themselves against volatility in the pound. And yes, again, this one has eased, but it is at still extreme levels. So before it was beyond that March pandemic level, it comes up again. However, these 1 month risk reversals are still the lowest, the most bearish, only beat 2 times. Once was in March, and the other time we saw this level beat was when the Brexit referendum happened. So still a lot of stress there, Francine.
Thank you so much. Our Danny Berger there with the very latest on pound movements on Brexit. Now let's get to the political angle. And for more on this, we're joined by Maria Tadeo in Brussels. Maria, when you look at the talks ongoing, does it get us actually closer to the deal, or could it always unravel?
Well, Francine, to some extent it does, just purely based on the fact that the two sides are still very much at the negotiating table. If the Prime Minister had wanted to walk away yesterday, Sunday, which was framed as a make or break deadline, that was a perfect opportunity to do that. Instead, we heard from both the Prime Minister and the head of the European Commission that they want to go the extra mile to make sure that they get this deal going if possible. It's also interesting, Francine, that the language around the level playing field from the European side has changed. On Friday, the head of the Commission was very clear that the EU does not expect the UK to do a copy and paste of regulation. If you move away, that's okay. We all get you're a sovereign country. We'll have to restrict and tweak our market access, but we don't want you to follow suit. We don't want you to copy. And perhaps that's something that could give the Prime Minister a helping hand. And just right now, we understand that, in fact, Michel Barnier is telling European ambassadors that he does see a path to a deal, that the EU perhaps could move on the level playing field, but in return, the Europeans are now expecting something meaningful on fish, and we understand that we're not quite there yet.
What will we see in the next 24 hours, Maria?
Well, Francine, it'll be key to see what type of reaction we get from this briefing from Michel Barnier, whether or not we hear from the Germans or we hear from the French. There was also speculation that perhaps we could see a trip from Ursula von der Leyen to speak to Emmanuel Macron and perhaps deal with Brexit on that note. And it's also interesting that the Prime Minister keeps saying, I am ready to go to Paris, I'm ready to go to Berlin, and that's what it takes to get the deal. So far, European leaders have said they don't want to speak to him on a bilateral way, and it's still very much about a Barnier-von der Leyen situation. But perhaps that could change in the next few days.
Thank you so much. I'm Maria Tadeo there, our reporter in Brussels. Now, the market's focused on the possibility of a Brexit deal. They're focusing on stimulus in the U.S. And overall, there seems to be a bit more upbeat optimism, maybe about a vaccine as well. So I'm looking at European stocks. They're gaining some 0.8%. Bloomberg surveillance, of course, continues in the next hour. We speak with the NatWest chair, Sir Howard Davies. We'll talk to him about Brexit. We'll talk to him, of course, about scarring in the economy as well, and the banking sector. All of that coming up. This is Bloomberg.
of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
Another shot. Boris Johnson and Ursula von der Leyen extend Brexit talks with yet another deadline ignored. Now, stimulus guarantees. Lawmakers in Washington will unveil a $908 billion pandemic relief bill today. Steve Mnuchin, Nancy Pelosi are set to speak again. Futures higher in the U.S. Plus, AstraZeneca lands a $39 billion mega deal to take over Alexion Pharmaceuticals. It's the company's biggest deal since it was founded. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London, Lisa Abramovitz in New York. Tom Keene off chopping the tree or something like that.
Yes,
Lisa, great to be with you. There's a lot to talk about. Brexit, I'm kind of tired of Brexit. I know most of the people watching are also tired of Brexit, but it is the final stretch. And I just want to remind everyone, the 31st of December is not a moving deadline.
Yeah, exactly.
So that's definitely a deadline that they should not be able to go over.
Which is key. And John Farrow, my colleague later on, he always been talking about what does a deadline mean when you get these deadlines and they just keep getting pushed back, yet we are getting to a hard stop. So any progress is really key at this point to prevent some sort of hard Brexit.
Yeah, and so we'll look at Brexit. We'll talk about, of course, AstraZeneca and that little thing called stimulus in the U.S. Now let's get straight to the Bloomberg First Word News. Here's Karina Mitchell. Hi, Karina.
Francine, good morning. Hospitals in the U.S. will start getting the coronavirus vaccine today. Shipments started leaving Pfizer's Michigan factory yesterday. Over the next 3 days, the shots will arrive at more than 600 hospitals. The 2.9 million doses will first be given to healthcare workers and nursing home residents. Meanwhile, Russian government hackers reportedly have hit several U.S. agencies. According to the Washington Post, the attack targeted systems within the Treasury and Commerce Departments and other government agencies. The newspaper says the agencies were breached through a server of a network management system called SolarWinds. And members of the Electoral College meet today to officially elect Joe Biden. Some Republican lawmakers have said that that would be the end of President Trump's attempts to overturn the results as far as they're concerned. Electors are committed to voting for the winner of the popular vote in each state. The president has said he'll continue with legal challenges. And he was the master of the spy thriller and defined the moral ambiguities of the Cold War between the Soviet Union and the West. British author John le Carré has died. He was once posted to Berlin in the 60s as an intelligent agent, and that city became the setting for his first bestseller, The Spy Who Came In From the Cold. Le Carré followed that up with novels such as Tinker Tailor Soldier Spy and Smiley's People. John le Carré was 89 years old. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Francine.
Karina, thank you so much. John le Carré, one of the most famous, I'm not sure I've read much, but I've seen all the films, and of course, one of the most famous names out there. 2020 really sucks. Now, this is what we're looking at when it comes to Brexit talks and the impact on the markets. Overall, there does seem to be a bit more buoyancy on the markets that we'll get something with Brexit, and bullish mood is also because investors are taking comfort from further stimulus bill negotiations in the U.S. and the impending deployment of the first vaccine over in the U.S. as well. well. The other thing I'm looking at is Japanese shares rallying to more than a 2-year high on Monday. But look, it's looking pretty good out there for the moment. Things can change, but for the moment, we'll take it. And happy Monday, Lisa.
Francine, thank you so much. There is a feeling that the pandemic is going to end at some point. And I think that the vaccine deployment in the United States and the sense that elsewhere you're going to get enough of a stockpile to potentially get that herd immunity by sometime next year is giving a lot of steam to this rotation into cyclicals. You can see this in an ongoing way in the United States. The S&P up 0.6% if you look at the futures, but futures on the Russell 2000, which is small cap stocks, that is beating the S&P, continuing this theme. Just to give you a sense, Francine, since the end of October, you've seen the Russell 2000 rally more than 24%. It's basically twice the S&P. Meanwhile, 10-year yields just blip up, controlled as we expect a Fed meeting where they could potentially announce a rotation into buying longer duration bonds, and gold selling off as it once again is proving less of an allure given the fact you are getting this risk-on feel in markets, Francine.
Yeah, a lot of focus, of course, on the rotation and what happens in 2021. Now, more on our top story. And European Union and UK leaders have agreed to keep negotiating a post-Brexit trade deal, extending Sunday's deadline.
Apart on some key things, but where there's life, there's hope. We're going to keep talking to see what we can do. The UK certainly won't be walking away from the talks. I think people would expect us to go the extra mile.
I think there is interest within the European Union to maintain a close and friendly relationship. We have the same values. We have a largely shared history. And I believe that in a globalized world, it's important to have solid, predictable partners on whom we can rely.
And we're just getting also headlines from Michel Barnier saying that, or he has told envoys that a fish compromise could see a deal this week. Now, we're delighted for Wisdom and, of course, Insight to be joined by Howard Davies. He's a NatWest Group chair, and Sir Howard has been very generous with his time over the last couple of years where we've always quizzed him on Brexit. Sir Howard, I'm really looking forward to the day where we don't need to talk about another Brexit deadline having been and gone. What does it mean for the City of London? Has finance moved on? Is there anything, are there any contingency plans that you're still putting in place in NatWest Group? And good morning.
Good morning, Francine. Well, I'm afraid I'm suffering from Brexit deadline anxiety. There's no doubt one German word that captures that, in that we don't really know when, if ever, this deal is going to be finished. But on your specific question about the city, I think that everybody who needs to do things, well, everybody, all the businesses I know about who needed to do something specific in the city to cope with the Brexit at the end of the year have done it. And if they haven't, then they should have their bottom smacked. But because that's been clear, the financial deal is not really a part of this negotiation. So we know that after the 31st, we will be out. But the deal is relevant to finance in that if we leave with no deal, clearly the political relationships will be bad, and the incentive to begin then to talk about some of the practicalities of equivalence determinations on different European directives, that willingness will not be there for some time. And so that would be serious from a city point of view. So it's the knock-on effect of no deal on the environment in which the other discussions need to take place that is the important thing for us.
But what does it mean overall for UK finance? Even if we have a deal, it could be a skinny deal, finance not in there. What happens to the City of London 12 months from now?
Yeah, well, it's quite interesting that even though where we are now is not where we wanted and hoped to be, because we've got a pretty hard Brexit with no equivalence arrangements, it's clear that the exodus of staff from the city that some forecast has not happened, and the city has continued to prosper. Interesting to speculate on why that is the case. Axel Weber of UBS said a week or so ago that he thought part of the reason was that the rest of Europe didn't have one centre to promote, that Paris spent its time knocking spots off Frankfurt and vice versa. So there's no single alternative location. But also I think that people have found ways of maintaining their business. Now, the dangerous bit, though, is that you are seeing people moving assets, moving trading books to other locations. And the risk is that as that happens, then the staff follow over time, I think that's quite a serious risk. And the other risk, which I think is not talked about so much, is that the regulatory environment in Europe, which, for example, doesn't normally require business to be done in a particular location. Location policy is not part of the European scene at the moment. Why is that? Well, it's because the European regulatory environment has been strongly influenced by the UK as the largest financial centre. Our regulators have had a big impact on it. I know that personally because I was the regulator for quite some time. And the question then is, once we are out of this, no longer involved in determining the nature of directives and regulations, what will happen? And there are plenty of people in Europe who are arguing that we should have, in Europe, a location policy. In other words, the ECB should be able to say where Euro business is transacted and where fund management decisions are made. At the moment, you can delegate them back to fund managers somewhere else. That's not a problem. So the question really is, how does the European regulatory environment evolve in a situation in which the UK is no longer in the room?
And Sir Howard, there are a lot of questions just generally about how Europe will treat regulation. The Bank of England, however, has given hints that banks will be allowed to resume dividend payments come next year after suspending them after March due to pandemic concerns. Just focusing on the here and now of some of the regulatory actions, is NatWest considering reinstating the dividend as soon as possible next year?
Well, the bank, I don't think it's quite right to say that the Bank of England have given a hint. They have set out a new policy, which I think is extremely sensible of them to do so. We still await a new policy from the ECB, which will be relevant to other banks. But the new policy says that you must operate your dividend policy within a couple of guide rails, expressed as a percentage of capital that would be the maximum percentage you could distribute in the next 6 months, and also a percentage of profit. And so you can go up to one or the other depending on your situation. That, I think, is a very sensible framework. It puts the decision making back where it should be, in my view, which is with the boards of banks. Boards of banks will have some difficult decisions to make, as will my board, because this is still a very uncertain environment. The Bank of England haven't been able to remove all the uncertainty. So I think banks will look very hard at that and decide on their dividend policy to take account of the great economic uncertainties that there are. But I suspect that some dividends will be restarted, but people won't have made that decision yet, and boards will need to think about that in the new year.
Some investors have said that the financial sector is uninvestable if dividends cannot be reinstated. Do you agree?
Well, it is certainly true that investors tell you that. And so if investors are telling you that, that's probably the most important thing. In that what they had said was, look, in the new capital regime, banks have been required to hold a lot more capital than they did in the past. And that means that they are safer, but they are less volatile and they are less profitable. And that's perfectly evident for all European banks in the last decade. Therefore, they're a bit more like utilities. That's been indeed the objective of the regulatory system, is to make banks more boring and more safe. But a utility that doesn't pay a dividend is a rather peculiar stock to hold, because the whole upside of being very safe and a utility-like stock is that you should be producing a decent income. So I think that's what investors mean when they say that banks are then uninvestable, because the upside doesn't seem to be there given the amount of capital that you have to hold. And yet the regular income stream isn't there either because the regulators have prevented dividends. So that particular combination of circumstances was very difficult for investors. And they've said, look, we just don't know how to value these stocks because we were valuing them on income to quite a large extent. And if we don't know whether the income will be stopped at any one time, then how do we value them? So their models just didn't really work. But I think that's the sense in which they were uninvestable at that time. Now, I hope that we can get away from that once the responsibility for deciding distribution policy is put back where it belongs, which is with the banks themselves.
Sir Howard, thanks so much. Sir Howard Davies there of NatWest Group stays with us. We'll talk a lot more about COVID, the pandemic, and some of these COVID loans as well. Now, in the meantime, the French President, Emmanuel Macron, is among speakers today at the 60th anniversary of the signing of the OECD Convention in Paris. There's Mr. Macron. I think we're also expecting the Prime Minister of Spain and others to talk a little bit later on. You can follow that on our Bloomberg terminal using LiveGo. And also, coming up a little bit later, we talk about the European Central Bank. We talk about inflation with Victor Constancio, the former ECB Vice President. That's coming up in about 30 minutes from now. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is Bloomberg Surveillance. Lisa and Francine from London and New York. Now, we're back with Sir Howard Davies of NatWest Group, and we were talking with Sir Howard about some of the dividends, about what it means for investors and actually banks as an investment. Sir Howard, I want to ask you a little bit about how you see, the pandemic playing out. How have the COVID loans been performing? Are people that need access to finance getting the right support?
Well, I think the answer to your second question is yes. We and the other banks have been able to respond to requests for financing. The one good thing you can say about the UK banking system is that it is strongly capitalised and is very much open for business. So the availability of loans, I think, has not been the issue. You just say, are they performing? Well, it depends what you mean by performing, because they're not performing in the sense of paying interest, because the interest has been suspended on them. So what we don't know is whether, when the schemes come to an end, which at the moment is supposedly at the end of March, whether companies will then be able to pick up and pay the interest payments on those loans. I mean, they're relatively low interest payments, of course, because they're guaranteed loans in some cases by the 100% by the government, in other cases 80%. So the performing question is the difficult one, and that's the one we're already starting to think about, is what happens when the schemes come to an end and when companies have got to start repaying interest. Now, of course, the hope was, when it was extended to the end of March, that by the end of March, the economy would be back and open, if you like. But I guess given what's been going on recently in terms of infection rates, that must be in question now.
So what do you think will happen? Are we going to see companies going bust? Are there going to be a lot of bankruptcies, or will some of these schemes have to be extended?
I fear we'll probably have a bit of all of those things. I mean, I think that the philosophy of the schemes, which was perfectly reasonable at the start, was that we were facing a V-shaped recession and that these schemes should bridge the V. In other words, they should allow companies to remain in being through this sharp decline in GDP enforced by the government's lockdowns. And then when the economy was reopened, then they could reopen. They'd have a bit more debt on their balance sheet, but there wouldn't be the long-term scarring that a large number of bankruptcies would involve. Now, of course, we now can see that it's not a straightforward V, this recession. I mean, at best, it's a W, because we came back up and then we've come back down again, and then we hope we'll come back up the other side. And I think that elongated V or W means that when we get to the other side of this chasm, there will be more business failures. I'm afraid that's inevitable. It sounds harsh to say that, but I think it will be clear that when the economy gets back to, quotes, normal, unquotes, that there'll be businesses that are no longer viable, either because the business has just gone away. We've seen huge changes on the high street and in the way people work and live, and that'll involve changes to business, or because they will just have so much debt on their balance sheet that they won't be able to survive. Those are the companies where I'm most concerned, the companies that are potentially viable, but not with the high degree of leverage that they'll have at the end. And I think we should be looking at schemes that can provide some kind of preference instruments, etc., for these companies who will otherwise struggle, but who might potentially be viable.
Sir Howard, the other factor here is that the Bank of England is considering taking interest rates negative in order to fight off further weakness in the economy as the pandemic continues to extend. How does that complicate your business model?
Well, there's two sides to that. One is the practicality of it, and you know, banks are working on that, and we have some experience because we have a bank in Ireland, and we've been operating in a negative interest rate regime under the ECB. So, you know, for the most part, we can technically do it, although there are certain issues in relation to retail customers. Can you really charge retail customers a negative rate? So that's not been done in Europe, and that's not been done because the ECB have provided negative rate funding to banks, which has helped them. So the issue would be if the Bank of England do go in that direction. It's not clear to me that they will, because there are clearly differences of view on the Monetary Policy Committee. But if they do, what do they do for an encore? You know, do they also do what the ECB have done, which is to provide, as it were, negative interest rate funding for the banks to allow them not to have to charge negative rates to individual retail customers? So we would need to see the whole package before we could assess what the impact on us would be.
Sir Howard Davies of NatWest Group, you're sticking with us. Thank you so much. Coming up in the next hour, Representative Dwight Evans. He is the Pennsylvania Democrat there. He's coming at 6:30 a.m. in New York, 11:30 a.m. in London. From New York and London, this is Bloomberg. sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Karina Mitchell with the Bloomberg Business Flash. Shares of AstraZeneca sank to an 8-month low today. The drug maker has agreed to buy Alexion Pharmaceuticals for $39 billion in cash and stock. That's a 45% premium to Alexion's closing price Friday. The company specializes in immunology and treatments for rare diseases. And Deutsche Bank may eventually allow some of its 4,600 employees in New York City to move elsewhere. The German lender is preparing to move operations to the Time Warner Center in Manhattan. It's discussing how to allow more employees to work from home and from other locations. And that is the Bloomberg Business Flash. Francine.
Thank you so much, Karina. And this is what the markets are looking at. We had a nice briefing from Sir Howard on Brexit and the impact it could have on the pound. Stocks really starting off the week in a bullish mood. Investors taking comfort for further stimulus bill negotiations. Also in the U.S., also encouraging news, I would say, about the vaccine in the U.S. In Europe, cyclical shares powering stocks higher. The pound also jumping after Brexit talks were extended past the deadline yesterday, raising hopes of a deal. And then we had some data out of Asia that was encouraging, including improving business confidence, helping Japanese shares rally. Now, we'll have plenty more, of course, on the markets. Also coming up on the open, Robin Hayes, JetBlue Airways Chief Executive. That's at 2 p.m. in London, 9 a.m. in New York. And this is Bloomberg.
Well, the main instruments on board include a dual-frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Lisa Abramowitz in New York, Francine Lacroix in London. Tom Keene is off getting a tree, we hear. Perhaps we will get an update, I'm sure, tomorrow when he is back with us.
6 in the morning.
Yes, of course. We will be hearing all about
one.
Vet Bill picking out a Christmas tree. Meanwhile, Howard Davies is still with us of NatWest Group. Howard, I want to talk to you, Sir Howard, about what we've seen in equity markets. Certainly, you see European equities and British equities off their all-time highs, but climbing despite the distress that we see in the economy. And over in the United States, one all-time high after another. Given this divergence between financial assets and the underlying economy, are you concerned about financial conditions at this point?
Well, I think the reasons for it are fairly straightforward in that, of course, you are penalized for holding cash. You're getting very, very low interest rates on fixed interest, and you get nothing at all, or indeed negative, if you hold money in a bank account. So almost anything, and you can see what's going on in the property market at the moment here as well, almost anything looks better than holding cash. So I don't think it's much to do, in my view, with an evaluation of earnings potential of companies for the future. It's more, where do you put your money for any kind of return? So I think at some point there is going to be a concern about valuations, because if you back out of these valuations assumptions about future growth and future profitability, you know, they look pretty implausible, those assumptions. So I guess as a general way, I mean, this is not something that, you know, we don't bet on the stock market here. So I think my views on this are as good as the next person on the tube, if you like. But you know, it does seem to me that the valuations are quite high in relation to earnings potential, given the growth prospect in Europe and the US.
Yeah, although as a lender, it does matter, right? Because it goes to the fundamental value of a company. And not only can you see equity valuations at sky-high levels, you can also see bond levels, credit valuations at sky-high levels with record low borrowing costs for some of the riskiest companies. How does that make your business incredibly challenging?
Well, it does. Yes, you're right that we are more concerned about the fixed interest market. But once again, I think what you have to understand is that these markets are not operating in a normal way, in that the involvement of the central banks in these markets is so extensive that, you know, you're looking at yourself in the mirror when you're asking yourself about valuations. You know, the central banks are such large investors in the bond markets that, you know, they are clearly distorting prices. Now, they're doing it deliberately. I don't mean that they're doing it, you know, just that they haven't noticed that they are. I mean, clearly the intention of the monetary authorities has been to push down rates as far as they can on all kinds of assets and all kinds of tenors. And they are succeeding in that. So what it means is that, you know, normal calculations of reasonable prices just don't really work, because you've got a buyer of last resort, or indeed a buyer of first resort, in the form of the central bank.
Sir Howard, if you look at, you know, what we've lived through in 2020, what are the main lessons that we can take with us for 2021? Is it the vaccines that, you know, with enough money behind it, we can really achieve anything? Or is it the social inequality that this will also once again put in place that governments need to readdress?
Well, I think that you gave me two choices, but I think I'd adopt a third one probably, Francine, and that is that what we have learned is that we do need the government in some circumstances, and particularly we need the government to do very dramatic things in terms of fiscal interventions, and that they actually do work. Now, people are worried about the long-term impact of these fiscal interventions, but in the short run, and certainly for this year, you know, I think people have been surprised by the degree to which governments have intervened, the amount of borrowing they've been able to do without pushing interest rates up, and to sustain the economy through an extremely difficult period for exogenous factors. I think that's the most important thing that we have learned. The second thing, though, on inequality, that's a good point you raised, because it is clear that the crisis has hit different people in very different ways. And on the whole, people who are in steady jobs, whether in the public sector or parts of the private sector that have been protected, like retail or indeed financial services, frankly, they've done fine. You know, their expenditure's gone down because they haven't been able to spend, and their income has not gone down. So we can see that a lot of families are cash rich at the moment. The Bank of England have pointed out, you know, there's a lot of savings that could be deployed to revive the economy if that happens. But the people who have suffered the most are young people in marginal, precarious jobs. So, you know, 1 in 5 people have had some reduction in their income, but 1 in 3 of the young people in London have had some reduction in their income. It's quite a big difference. And a lot of those people are women, young women as well. So we have seen a big impact on inequality, and that will have to be a major theme when we come round to deciding how we reset the fiscal position. And so people, you know, the governments are going to have to think about how they recover. There will be some tax increases, we all know, and there will be some spending cuts and things, you know, but they will have to calibrate those to recognize the relative impact of the sector, of the financial crisis and the COVID crisis on different parts of the workforce. So I think that's the lesson for the future. As the Treasury now thinks about what it's going to do for an encore, that's where they have to register the impact of the crisis on different groups.
So Howard, if you look at, and you know, you make an excellent point about it, you know, almost a social contract between citizens and the government has changed. Will that actually, you know, change for the foreseeable future? So are we going to expect governments to intervene in companies, you know, well after we've dealt with COVID-19?
Well, I think we probably will, and we have the unusual circumstance of a Conservative government arguing with the EU for the right to intervene and support companies and, you know, use state aid. So we clearly have, you know, ideologically, things have turned on their heads. And I don't think you hear anybody now talking about, as George Osborne used to do, you know, we want government to be radically smaller as a share of the economy. That's not going to happen. The problem, I think, here is going to be, well, if we accept that the government is going to be a larger part of the economy for a while, at least, how do we fund that? Because we've got some peculiar, really peculiar rules, laws in place indeed, where governments have said we will not increase the basic rate of taxation, we will not increase the rate of VAT, we will not increase national insurance. And all of those have been legislated. Those are the 3 big sources of government income. And so how are we going to fund a significantly larger state? And I don't hear any answers to that question at the moment. And I think that's going to turn into a big question in 2021, 22 and beyond.
Thank you so much, Sir Howard. We'll have to get you back on to talk about debt longer term. Sir Howard Davies there, the NatWest Group chairman. Now let's get straight to the Bloomberg First Word News. Here's Karina Mitchell. Hi, Karina.
Francine, good morning again. Healthcare workers and nursing home residents will be first in line when U.S. hospitals begin giving coronavirus vaccine shots. The first 2.9 million doses will arrive at more than 600 hospitals over the next 3 days. Pfizer is sending the vaccine in containers filled with dry ice to keep the formula at 94 degrees below 0 Fahrenheit. Meanwhile, President Trump says those working in the White House should get the coronavirus vaccine somewhat later in the program. That follows news that he and other top U.S. officials would be offered the vaccine within days. The president has said on Twitter he asked that the adjustment to the timetable be made. He says he's not scheduled to take the vaccine but looks forward to doing so at the appropriate time. And a group of Republican and Democratic lawmakers will unveil a $908 billion coronavirus relief plan today. There's still doubt that Congress will pass it, however, so they'll offer language for 2 separate bills. One will have provisions that have divided lawmakers. It will call for state and local aid and liability provisions for businesses. And trade talks between the UK and the European Union have gotten another stimulus. British Prime Minister Boris Johnson and EC President Ursula von der Leyen once again gave negotiators more time to close a deal. Officials involved in the process say agreement may finally be reached this week. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Back to you.
Thank you so much, Karina. Up next, we've got Vitor Constancio. He's former ECB vice president to talk a little bit about quantitative easing forever. From New York and London, this is Bloomberg.
opportunity ya stima ningeipata naweza sikia vizuri sana kwa sababu natumia nguvu sana.
The advantage of the electric hand cut over the manual conventional hand cut is that one, it increases the productivity level of the users. Two, it is eco-friendly in that it does not pollute the environment. Three, it increases the income level for their users in terms of loading capacity and also in terms of productivity.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance. I'm Francine Lack in London, Lisa Abramovitz in New York. Now, the ECB made a stark admission last week as it announced a fresh round of policy measures. Even 3 years from now, it's still well be short of its inflation goal of just under 2%. Well, joining us now to discuss inflation, to discuss some of the financial stability mechanisms that the ECB wants to put in place is Vitor Constancio. He is former ECB Vice President. Vitor Constancio, thank you for joining us on Surveillance. Are investors underestimating the pain at which the European economy will have to go through because of companies going bust as we readjust to a new normal?
Well, next year we'll face some problems, no doubt. But at the same time, there are many good news that bright the forecasts. In the first place, there was, of course, the recent final approval of the big package of the recovery fund, which at least in the second half of next year will start to distribute money to countries, helping the fiscal stimulus in all member countries. And at the same time, the package approved by the ECB will help along the way, both in terms of supporting any independent decision by fiscal authorities to have an appropriate fiscal stimulus next year, but at the same time helping the credit supply because of the extension of the TLTROs, providing at a very low interest rate, -1 in fact, to banks in order to keep up the credit supply to the economy. It is true that next year banks will start to face the materialization of some NPLs that come out of the crisis in the firms that have more problems. But at the same time, I think that the governments, as part of their fiscal policy, will have to extend also the mechanism of guarantees to bank loans in order to continue to support credit supply.
But, Mr. Constancio, when you look at some of the debate out there, and we've been trying to get to the bottom of, there's been so much debt creation, and no one's talking about austerity, but if there was a sudden bout of inflation, that some economists in some corners are expecting in Europe, because of this stimulus, if we have vaccines that work quicker than we thought, if we have inflation, could the ECB even afford to raise interest rates?
Well, if we have inflation, and that's a big, big if. In the first place, I point to the fact that the ECB itself published forecasts that put inflation, even in 2023, well below 2%. And in fact, I think that in the horizon of, say, the next 6 years, I don't see inflation really increasing significantly. There are no drivers for that to happen. The recovery out of this deep recession will not be too buoyant, because households will increase their precautionary savings. It has happened always after big crises. Firms also are a little bit risk averse before they see demand really jump start, which means that it is only fiscal policy that contributes to the increase of aggregate demand and growth. So the recovery materializes on top of a very depressed economy this year, but it will not be leading to overheating. In fact, I think that all projections indicate that we will not attain in Europe the levels of GDP of 2019 before 2023. So you see, the recovery will be a bit sluggish. And there is then no reason for inflation to flare up. If you look to the past 25, 30 years, inflation both in Europe and the US has hovered around 2% during such a long period of time. And before that, only oil shocks or located wars led to episodes of higher inflation. So I don't think that we will have oil shocks in the present environment, with all countries increasing investment in renewable energy. And I don't see indeed drivers in the next 6 years to lead to significant inflation. And if you mention monetary developments, well, we can just go back and see that since 1999, the balance sheet of the ECB increased by almost 1,000%. M3, the money supply, increased by 200 and something, and inflation increased only by 25% throughout this period. So we cannot really apply reasoning of quantitative monetary theory because it's not working for various reasons. So the big theories of inflation have been discredited by this period of a long, long period where they have not worked, for reasons that can be explained, but we have no time now to go into.
Well, Vitor, as I hear you talk, and this is what a lot of people are saying, it's unclear whether some of these quantitative easing and some of these monetary policies have been that effective in getting the ultimate goal of juicing inflation. And here we are, we have major central banks around the world expected to inject another $2.8 trillion into the financial system with bond purchases in next year alone. Is there a sense that A, there is no exit strategy, and that B, these policies are not effective but have to continue without fear of perhaps disrupting the entire financial system irreconcilably if they were to try to exit?
Well, of course, there are diminishing returns of these policies in what regards their impact in the real economy. That was already clear before COVID. Because what monetary policy does is to provide indirect incentives by creating expansionary financial conditions. But we know that for the expenditure decisions, both for households and firms, other conditions are necessary, and sometimes indirect incentives are not enough. So that's why this year and next, fiscal policy, actual expenditures and income transfers are essential to support recovery. And monetary policy helps that, because even if the decision about monetary policy is independent from fiscal policy, there are convergence of the two policies when we are at the zero lower bound of interest rates, and the two policies have to collaborate and are collaborating. And the fact that fiscal policy will continue to provide stimulus is helped by monetary policy, and that will contribute to a more robust recovery. And then this also means that when we have a more robust recovery, say by 2023, 2024, the central banks may start really thinking about a gradual shrinking of their balance sheets.
Vitor, before that time, could you foresee the ECB buying equities?
No, I do not. I think that is a very difficult step to take for very reasons, because it's very risky. It's legal, it could be done, it's not forbidden, but I think that it's very difficult to see that happening. And I don't anticipate really another extreme situation like the one we have this year that could justify such a move.
Mr. Constancio, when the ECB pledges to keep financial conditions stable, is this really monetary stimulus?
Well, yes, because precisely monetary policy is transmitted via the financial variables of financial markets. That's one channel of transmission. And that is then to be expected to keep those favorable financial conditions that also will help fiscal policy next year.
All right, thank you so much for joining us. Vitor Constancio there, the former ECB Vice President, joining us this morning. Now, coming up in the next hour, Joshua Sharfstein, he's Johns Hopkins Bloomberg School of Public Health Vice Dean. That interview on vaccines and also what AstraZeneca said that it's developing or at least looking into with Russia. That's at 11:30 a.m. in London, 6:30 a.m. in New York, and this is Bloomberg. We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. Happy Monday, everyone. This is Bloomberg Surveillance. Lisa and Francine from London and New York. Now, if you look at the markets, there's definitely a little bit of optimism out there. Now, part of the optimism is because we could see something in the U.S. in terms of a stimulus bill. Also, a bit of optimism that we're not looking at a no-deal Brexit. Again, this could change very fast, but for the moment, there does seem to be a bit of buoyancy on the markets that certainly these Brexit talks have been extended past the Sunday deadline, and that's raising hopes of a deal. The other thing that I think the market is also also looking at is impending deployment of the first vaccine in the U.S. So I'm looking at European stocks are gaining 1%, pound retracing some of the volatility that we saw last week, and then you can see crude oil 46.95. Lisa.
Yeah, and one thing that as you talk about this risk-on appetite, you're seeing that rotation into cyclical stocks continue to gain momentum. In the U.S., you can see that with the Russell 2000 outperforming. If you look at futures contracts, the S&P up nearly 1% versus the S&P 0.6%. Just to give you a sense of where we've come from since the end of October, the Russell 2000 small cap stocks have returned twice as much as the S&P, 24% in that time. 10-year yields just dip up a little bit ahead of that Fed Reserve meeting. We're going to get a decision from them later this week. And then gold selling off just a bit, that risk-off feel, Francine, seeming to be pervasive and consistent.
Yeah, we'll have, of course, plenty more on this great rotation of what it means for the next 6 months. Also coming up in the next hour, Valerie Grant, AllianceBernstein Senior Portfolio Manager. It'll be interesting also to get her thoughts on gold. I think gold really seeing a pretty dramatic move today. We'll get more on gold and also bonds. This is Bloomberg.
Some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Another shock, Boris Johnson and Ursula von der Leyen extend Brexit talks with yet another deadline ignored. No stimulus guarantees. Lawmakers in Washington will unveil a $908 billion pandemic relief bill today. Steve Mnuchin and Nancy Pelosi set to speak. Futures higher in the U.S. Plus, AstraZeneca lands a $39 billion mega deal to take over Alexion Pharmaceuticals. It's the company's biggest deal since it was founded. Well, Well, good morning, everyone, and happy Monday. Bloomberg Surveillance. I'm Francine Lack in London. Lisa Bamovitz in New York. Tom Keene off today. Lisa, we look at the market. Of course, we look at the rotation. We look at some of the cyclical stocks. It's great that you're mentioning, actually, the Russell. And then what we're also looking at, I guess, is pound. It's interesting to see how much appetite there is to understand Brexit talks, and yet so many people saying, look, they've kind of moved on from it. It's just in the case that we have a no deal that there could be some significant repricing.
It feels like the more things change, the more they stay the same. We're still talking about Brexit. We're still talking about some sort of fiscal support in Washington, D.C. We're still talking about when we're going to get a critical mass of individuals vaccinated for COVID. And yet things do seem, Francine, to be progressing a bit.
Yeah, they certainly do. Certainly, the sentiment on the market is buoyant today. Now let's get straight to the Bloomberg First Word News. Here's Karina Mitchell. Hi, Karina.
Francine, good morning. Hospitals in the U.S. start getting the COVID-19 vaccine today. Shipments started leaving Pfizer's Michigan factory yesterday. Over the next 3 days, the shots will arrive at more than 600 hospitals. The 2.9 million doses will be first given to healthcare workers and nursing home residents. In other news, Russian government hackers reportedly have hit several U.S. agencies. According to the Washington Post, the attack targeted systems within the Treasury and Commerce departments and other government agencies. The newspaper says the agencies were breached through a server of a network management system called SolarWinds. And members of the Electoral College meet today to officially elect Joe Biden. Some Republican lawmakers have said that would be the end of President Trump's attempts to overturn the results as far as they're concerned. Electors are committed to voting for the winner of the popular vote in each state. The president has said he'll continue with his legal challenges. And he was the master of the spy thriller and defined the moral ambiguities of the Cold War between the Soviet Union and the West. British author John le Carré has died. He was once posted to Berlin in the 60s as an intelligence agent, and that city became the setting for his first bestseller, The Spy Who Came In From the Cold. Le Carré followed that up with novels such as Tinker Tailor Soldier Spy and Smiley's People. Jean le Carré was 89. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg Fran.
Karina, thank you so much. The market, as Lisa was saying, really focused on some of the positives out there. That is the vaccines being rolled out soon in the U.S. as well. That is Brexit negotiations not ending just yet. And so stocks are actually kicking off a week on a pretty bullish note. Again, it could change, but for the moment, they're supported by a couple of things. Further stimulus bill negotiations in the U.S., also a possible deployment of vaccines, and the fact that there's still hope that we can get a Brexit deal. I'm also looking at some of the things in Europe. It's definitely cyclicals that are leading the way. And then you can see pound, euro pound 90.47. But if you look at cable, it's 134.34.
Yeah, Francine, it's the same kind of story you can see in the U.S. You see S&P futures poised for another record high. Russell 2000 outperforming, building on gains earlier. If you look at futures, up now more than 1%. The interesting thing is that bonds are not participating. They are not sending the same story. Yes, yields bleeding a little bit higher, 92 basis points in the 10-year, 0.92% yields, yet still so much lower than many people think would be necessary if there was this cyclical rotation being borne out in the economy, and gold selling off just a bit. There seems to be this optimism, as you were talking about, Francine, based in part on the stimulus. West Virginia Senator Joe Manchin guaranteed that this time is different. They're actually going to get some sort of deal done. He was speaking on Fox News Sunday. Take a listen.
We were on the call all day yesterday. We get on the call again this afternoon to finish things up. We'll have a bill produced for the American people tomorrow, $908 billion.
So this time, something will get done. Joining us now is Valerie Grant, AllianceBernstein Senior Portfolio Manager, focusing on responsible investing. Valerie, when you take a listen to the will we or won't we get some sort of fiscal support deal done, there is a question, what is currently baked into the market? What's your sense of that?
My sense is that the market is baking in some form of fiscal stimulus and has been for some time. I think many people were hoping for at least $1 trillion in stimulus, but you know, the $900 billion or so is still, I think, sufficient to bridge the economy until a point where the pandemic is contained. The thing that I have to remind everyone is that this pandemic has had a disproportionate disproportionate impact on lower income households. And so hopefully this fiscal stimulus will avert hunger and homelessness and provide a bridge for those who have been displaced due to the COVID-19 pandemic. So I'm very encouraged.
Valerie, not to diminish what you're talking about, because honestly, that is so important to understand the pain and the disparities that have been exacerbated by the pandemic. Markets have ignored this for the large part. If you take a look at the record highs that we're seeing on the S&P, the Russell 2000, and there is a question as you talk about the bridge to the other side. It's not stimulus. It is a stopgap measure. Does it justify this concept of a rotation into higher risk stocks that actually do count on fundamental growth when we're talking about just plugging an extended gap in production?
So let me try to unpack a couple of different things that I think are at work here. First of all, the markets are pricing in certainly fiscal stimulus, but also lower rates, and then a significant recovery in the overall economy. So we've talked about fiscal stimulus, and then if you look at rates, I think that people are expecting rates to be lower for longer. And what that means is that companies are facing a much lower cost of financing. I think we'll continue to see increased activity in mergers and acquisitions, and also refinancing of debt, so companies will have strong balance sheets. And then as we look at the underlying profitability of companies, it's actually been quite strong. Many companies have taken steps to adjust their cost structure as a result of the pandemic, and some of those savings will persist. So I think that the market is pricing in future cash flows, which actually look pretty robust.
Where do you see, Valerie, do you see bubbles in certain parts of the market, and what would be the catalyst for these bubbles to burst?
I don't know that we see bubbles. I think essentially what has happened because of the pandemic is that there's been an acceleration of some pre-existing trends. And so if you look at the technology sector broadly defined as an example, the pivot to e-commerce accelerated dramatically. Electronic payments or online payments accelerated dramatically. And that also had an effect on other industries which saw pretty significant contraction in demand. And so I think that it's not that it's a bubble necessarily, but we've seen an acceleration of pre-existing trends as a result of the pandemic.
What will change actually in 2021? Is there going to be a sudden realization that we could have inflation, or do equities catch up with fundamentals?
We're not seeing a lot of evidence of inflation currently. The one area that I'm focused on in terms of the possibility of inflation is in labor costs or in wages. And so we are seeing for some industries, as an example, in transportation, obviously in warehousing and certain retailers, there is a very strong demand for labor, and they're facing labor shortages. And so we could see some inflation in wages, but quite frankly, as I said, many companies are able to offset the increase in wages with savings in other areas. So I don't think it's a significant concern.
Valerie, you talked about how some sort of stopgap measure in Washington, D.C. would help keep people from being hungry, the disparity from widening between lower income and higher income individuals. How do you view, in light of that growing disparity, the run that we've seen in equity markets, this idea that anyone who can invest in equities has done incredibly well and built their wealth, while those who have been unable to have actually lost even more capital in terms of their employment prospects globally? How do you justify that in terms of how that will bleed into the economy and your investments?
Well, I think that we are really looking at a situation where if you're an asset owner, then you've done quite well more recently because you've been able to participate in the recovery. But if you're not, then obviously things have been much more challenging. I think that what companies are doing in particular, because what I focus on is looking at what companies can do in terms of their own policies and practices, is to invest in human capital and invest in talent so that people actually have a pathway to future career growth and income growth, right, from the entry level up through the ranks. And you do see many companies investing in those areas, such as tuition assistance and profit sharing and so forth.
Do you have a sense of the performance of these companies? In other words, can you say to investors, not only is this a great story and it makes you feel like you're actually doing something to help people, but you're going to get bigger returns? Is there any evidence of that?
There is evidence that in some cases, companies that make these types of investments are also good investment opportunities. The two don't always go hand in hand. So it's important to assess both the responsibility characteristics as well as the underlying fundamentals and see where they converge. But one of the things that we've been doing some research on internally is to look at the investments that companies are making in human capital, really the same way we think about dividends and the way that companies are signaling that they have a positive sense of the future because they're investing in their human capital and talent. So I take it very much as a positive indicator when I start to see some of those investments being made.
Valerie Grant of AllianceBernstein, you are sticking with us. Thank you so much. Coming up, Democratic House Representative Dwight Evans from West Philadelphia talking about not only fiscal policy, the election, and the road ahead from the pandemic. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. Lisa and Francine from London and New York. Now let's take a look at some of the themes investors are watching this week. Later today, the electors in each U.S. state officially cast their vote for the next U.S. president. Congress must also accept those electors, making President Trump's legal challenges extremely unlikely to change the election's outcome. On Tuesday, we'll get the latest reading of China's industrial production and retail sales data. Wednesday, Fed Day, the central bank announces its rate decision and is expected to provide new guidance on asset purchases. And then on Thursday, the Bank of England takes the spotlight. It is expected to keep policy unchanged. And then Thursday as well, the US FDA meets to scrutinize Moderna's COVID-19 vaccine. An authorization could be granted soon after. Let's we'll put all of that in perspective and context, and let's get back to Valerie Grant of Alliance Bernstein. Valerie, when you look at 2021 and some of the valuations out there, which I know Lisa wants to talk about, are we going to see more consolidation? If you look at GDP and I guess the momentum lost in the economy, when will we go back to where we should have been had we not had the pandemic?
So I think it's very difficult to go back and say, well, where should we have been? The reality is we've seen a lot of momentum stocks and growth stocks outperform this year, but more recently, value has done quite well. And so I think that it's important for investors to remain balanced and to have balanced exposure really in their portfolios, because there will be periods during which certain styles or certain investment approaches will work better than others, but it's very difficult to make those calls in advance, and the turns can be quite sudden.
Where do you protect yourself? How do you protect yourself? Is now a good opportunity to buy gold in a portfolio, or do you go to cash?
So no, I'm fully invested in equities. The portfolio that I manage is 100% in equities, and actually in U.S. equities. So I really look for diversification within the equity portfolio. And so when I talked about maintaining different types of exposure, I meant different types of exposure within listed equities. People may choose to have other asset classes in their overall asset allocation, but within equities, I really seek to maintain diversification across style as well as across industries and sectors.
Do you get a sense, Valerie, that big tech is still a haven in terms of equity allocations?
I don't know that I would call it a haven. I think that there are opportunities across all sectors and industries. We see opportunities in industrials. We see opportunities in consumer discretionary. We see opportunities across a host of different industries. I think tech attracts a lot of attention because there's so many different industries there, and also there's a fairly wide dispersion, meaning there's an opportunity for stock picking. But the same is true actually in consumer discretionary and in other sectors as well. So no, I don't think it's